Most world conversations focus on the same categories: property, equities, cash, or pensions. But there's an entire asset class sitting outside all of that with a genuinely different return profile. It's called litigation funding. Today I want to walk you through it properly. I'm Annette from Carey Suen. I spent over 41 years helping people around the world make sense of the wealth, from first-generation high earners in the UK who've worked incredibly hard to build what they have, to established families across Hong Kong, Singapore, the Middle East and beyond. In that time, I've worked through bull markets and crashes, low interest rate environments and high ones. And one thing I've learned is that investors who come out ahead aren't always the ones who take the most risk. They're the ones who find genuinely different sources of return that don't move with everything else. By the end of this video, you'll understand what litigation funding is, how it works, why institutions have quietly used it for decades, and whether it's worth exploring for your own portfolio. So what is litigation funding? Let me start with the mechanics, because once you understand how it works, everything else will make sense. Businesses and individuals sometimes have strong, well-evident legal cases, but pursuing them is super expensive. Lawyers, expert witnesses, court costs, it adds up fast, and many simply can't fund it themselves. The litigation funders step in to cover those costs entirely in exchange for a share of the settlement if the case is won. If the case is lost, the investor's capital is protected through insurance. So the funder absorbs the case risk and the insurance absorbs capital risk. It is worth being clear that protection is only as robust as the policy and provider behind it. That's why due diligence matters and why this isn't something you'd find on a standard retail platform or offered from your bank. So what does this look like in practice? Let me give you a sense of the scale, because the numbers are significant. Globally, major settlements exceeded $40 billion in 2025 for the fourth consecutive year. This is a vast, active market. A few well-known examples. Burford Capital, the world's largest listed litigation funder, invested around $16 million backing shareholders in a dispute over Argentina's seizure of energy company YPF. The court awarded $16 billion in damages in 2023, and Burford's estimated share of that recovery was $6 billion. The Blue Cross Blue Shield antitrust case, health providers alleged anti-competitive conduct, that settled for $2.6 billion, demonstrating the scale class action litigation can reach. Across all concluded cases, Burford has reported an average return on invested capital of 87% and an annualized return of around 27%. These are headline cases, not typical outcomes, but they reflect an asset class with real institutional track record behind it. So why do high net worth investors find this interesting? Well, a few reasons, and I'll be pretty straightforward about each. First, there is no market correlation. Litigation outcomes are completely independent of market. A case doesn't settle differently because the S&P or FTSE had a bad quarter. That kind of truly uncorrelated return is genuinely rare. Second, the commitment period. This is where it often surprises people. The legal cases themselves can run for years, but your capital is deployed for just 90 to 120 days at a time. Both income and capital growth can be compounded across successive deployments, short structured cycles that roll and build over time. Third, rigorous vetting. Only a fraction of cases make the cut. That selectivity is part of what makes this asset class function. And fourth, investors are positioned at the front of the repayment queue. So when a settlement pays out, they're first in line to recover their capital. So how does this compare to traditional investment options? Well, cash loses purchasing power to inflation steadily over time. Slow erosion, but very real over 5 to 10 years. Litigation funding generates returns independent of inflation or interest rate cycles. Equities growth potential, but when markets fall, most assets fall with them. So litigation outcomes don't do this. Gold diversifies somewhat, but generates no income, only capital appreciation, whereas litigation funding generates returns on successful cases and compounds across short deployment cycles. This is an asset class that institutional investors have understood for years. It's only recently become accessible to private wealth clients. So exactly who's this for? Well, the investors who tend to find this most useful are high earners who already have a foundation, savings, property, pension, people whose sense of capital isn't performing the way it could. not looking for speculation, looking for genuine diversification and structure. So if you value understanding what you're investing in rather than trusting a label, and you like the idea of capital working in short, defined cycles with a clear protection mechanism, there's a link below to book a free introductory call. I'm happy to answer any questions you have.